Thanks for clicking. With the Bank of Canada raising interest rates this month by 100 basis points, there is increasing downward pressure being put on Canada's real estate market. However, there may be some relief in sight, as mortgage rates reversed last week, with bond yields dropping on news that Canada's inflation rate came in 30 basis points lower than expected. This comes at a time when Canada's real estate market is under increasing pressure, with RBC predicting a 23% drop in sales and a 12% drop in the benchmark price by April of 2023.
Yes, and we're grateful to them.
With Canadian home prices dropping and mortgage rates dropping as well, at least for now, this is changing the affordability for Canadian homebuyers. So what I want to do today is go over the best mortgage rates compared to last month, take a look at how that has changed affordability, look at why mortgage rates are dropping in the face of rising interest rates on the part of the Bank of Canada, and then take a look at what to look for next. Speaking of next, we are waiting for June's real estate data set to be out early next week from the local real estate boards. We will obviously have updates out on that data on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into these mortgage rates. On to the mortgage rates. First up, the best insured mortgage rate. The insured mortgage rate, if you'll remember, that's where you put less than 20% down, you pay the mortgage insurance, and you have a 25-year amortization. Mortgage rates dropped last week. If you'll remember, in May we had a best insured rate of 4.19. That bumped up to 4.99 in June. And as of last week, it just lowered down to 4.64, a 0.35 drop since this time last month. Insured mortgages almost always have the lowest rate, as it's of the least risk to the lender, as you've paid the mortgage insurance. So in the event that the home buyer doesn't pay, the mortgage insurance is there to cover any losses, most of the losses, on the part of the mortgage lender. Therefore, they offer the lowest rate. On to insurable. Insurable is where you put 20% down, you don't pay the mortgage insurance, and you qualify with a 25-year amortization. Those rates also dropped last week. If you'll remember, in May, the best insurable rate was 4.54. That shot up in June to 5.39 and went back down last week to 4.99, or 0.4 lower than it was this time last month. When you qualify at an insurable rate with that 20% down but a 25-year amortization, it allows the mortgage lender to buy insurance on the back end. So they can still insure the mortgage in the event that the home buyer doesn't pay, but the home buyer doesn't pay for that mortgage insurance.
That's so generous of you.
Finally, uninsurable rates. Uninsurable, that is where you have 20% down and you take a 30-year amortization, or anytime you take money out of your home, vis-a-vis a refinance. Uninsurable rates are also down, although not by very much. If you'll remember, in May, the best uninsurable rate was 4.74. That shot right up in June to 5.39, and that lowered last week to 5.24. or 0.15% lower than it was this time in June. So insured rates, insurable rates, and to a certain extent uninsurable rates are all down since this point in time last month. But what has that done to affordability? If we take a look at the average price in Canada in June, which was $665,849. If we use minimum down payment requirements, a 25-year amortization, and we look at June's interest rate, we get a mortgage payment of $3,791. However, if we use that 4.69 interest rate, we see the payment drops to $3,660. So a little over $130 difference on that average house price in Canada. But what about looking at the benchmark price? The benchmark price, that's the price for the home which contains the most popular set of features in Canada. The benchmark price in June was $809,700. So again, if we use minimum down payment requirements on a 25-year amortization and a 4.99 interest rate on that benchmark price, we get a payment of $4,577 and change. Now, if we take a 4.64 interest rate, we get a payment of $4,419 and change. And this is what we've seen for over the past few months, with affordability changing up and down with the ebb and flow of interest rates. The only thing that has been a constant is house prices dropping.
Unsettling, isn't it?
And though Canada's real estate prices are forecasted to continue to drop for the foreseeable future, it's still far too early to tell the direction that mortgage rates are headed. Mortgage rates are based largely off bond yields. That is, how much money can be made from the Government of Canada's bonds. If investors think that inflation has peaked and we are entering into an economic downturn, and that the Bank of Canada is going to be reversing course in order to re-prop up the economy from that economic downturn, then we'll see bond yields fall and mortgage rates will fall thereafter. Mortgage rates are almost always higher than bond yields, as there's no safer debt in Canada than government debt. So, as mortgages are a little bit more risky than government debt, they charge a premium for the additional risk. However, bond investors are a fickle bunch.
What you're saying is libelous.
Canada's inflation rate coming in at 8.1%, only 30 basis points lower than that was expected, was enough to shift investors into the mindset that inflation may well have peaked and that they now had to worry about an economic downturn and that the Bank of Canada would eventually be lowering interest rates in order to re-prop up the economy. So, in summary, as inflation came back lower than expected, investors are expecting the Bank of Canada to reverse course, and as such, the yields on Canadian government bonds dropped, which were followed shortly thereafter by mortgage rates. But it's not clear that these bond investors have it correct, and it's definitely not clear that the Bank of Canada will be reversing course if an economic recession hits. During an interview last week, as we went over on this channel, Bank of Canada Governor Tiff Macklem made it clear that inflation is their number one priority.
Getting inflation back to our 2% target is paramount.
Even if Canada does enter into a recession, it's not clear to me at least that the bank will reverse course if we still have sky-high inflation. Even if our inflation rate is down to say 7% and Canada enters into an economic downturn, it's not clear that the bank will shift focus to the economy to re-stimulate the market. I think they're going to try to get a hold of inflation sooner rather than later, and that is going to be their number one focus going forward. I think if inflation remains at 7 or 8%, the Bank of Canada is going to continue to raise rates, which will put more upward pressure on bond yields, which will put even more pressure back to put those mortgage rates back up. So this very well may have been a blip, but mortgage rates are down for now, and as such, the affordability for Canada's real estate market has increased. Marginally, only by $100, $130, but increased nonetheless. We'll obviously have updates out on that affordability and on those prices next week. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.